Good afternoon, everyone, and welcome. Thank you for taking the time to join us for our mid-year market update. We appreciate you being here and are grateful for the opportunity to spend some time with you today. My name is Michael Matheson, and joining me are Scott Robichaud, Susan Anderson, and Marie Henricks. Good wave, Scott. Our advisor team here at M2. On behalf of us all here, thank you for your continued trust and for taking the time to be with us. Today's presentation is based on market and economic commentary provided by LPL Financial. Our goal is to share an overview of what's happened in the market so far this year, discuss some of the key themes we're watching, and provide perspective on the current investment landscape. Please keep in mind that today's presentation is intended for general information and educational purposes and not intended to provide individualized investment, tax, or legal advice, and everyone's financial situation is very unique. So with that, why don't we get started? I think we've got about 4 hours today, gang. Is that right? We each get an hour? We've timed the presentation. We think we're at 30 minutes or so. So we appreciate you joining along. So let's talk about one of the big things that's on everybody's mind right now. Of course, we've got big stuff coming up with the election this year. I want to talk just a little bit of overview of this. With the House of Representatives, for instance, all 435 seats in the House are up for re-election. The current House makeup is 217 Republicans, 212 Democrats, 1 independent, and 5 vacancy. Democrats would need a net gain of 6 seats to reach the 218-seat majority threshold and win control of the chamber. The outlook currently is that there are about 35 competitive races out there, and analysts that track this believe that the Democrats are favored to take control of the House, but by relatively small margins. Switching over to the Senate with an overview, there's only 35 seats in the Senate up for re-election, which include 2 special elections in Ohio and Florida, as J.D. Vance left his seat to serve as vice president and Marco Rubio left his seat to act as Secretary of State. The current Senate makeup is 53 Republican, 45 Democrats, and 2 independents who caucus with the Democrats. Of the seats up for re-election, 22 are currently held by Republicans and 13 by Democrats. Democrats need to flip at least 4 Republican seats to claim a majority. The current outlook is that there are currently 9 competitive races, and analysts believe that the Republicans will retain control of the Senate. So with that said, let's talk about some potential scenarios and what the impact of these may be. Marie?
Yeah, thanks, Mike. Scenario number 1, which is currently considered the most likely scenario, and as Mike already mentioned, is that Republicans will lose control of the House, but maintain control of the Senate. With legislative pathways constrained, the White House would rely more heavily on executive orders, agency rulemakings, and regulatory reinterpretation to advance its policy agenda. This would shift focus from Congress onto the administrative state. A change in the policymaking process creates a different set of winners and losers. Agencies could continue advancing the administration's agenda through rulemakings, particularly on crypto market structure, public company disclosure, e-delivery, private market access, and capital formation. Stakeholders seeking statutory changes that require bicameral agreement will have an uphill battle, as divided control would make it harder to move large or partisan legislative packages. Bipartisan measures, such as a capital formation package, could still advance, but House and Senate leadership would need to make a concentrated effort to resolve policy differences and prioritize limited floor time. Affordability measures could still move on a bipartisan basis, but Democrats may be reluctant to give the administration a major legislative win ahead of the 2028 presidential election without securing significant policy concessions.
Yeah, thanks, Marie. In scenario 2, we potentially could have Republicans losing control of both the House and the Senate. If Republicans did lose control of both chambers of Congress, legislative activity could remain constrained due to likely narrow Democratic majorities and the president's ability to veto legislation that does not align with the administration's policy agenda. With tight margins, it would be very difficult for Congress to override presidential veto in both chambers without a strong bipartisan support. As in President Trump's first term, Democratic leadership in both chambers would place significant emphasis on oversight to shape political narratives heading into the next presidential election. Democratic majorities would likely focus on advancing Democratic priority legislation to show voters what they could accomplish with unified congressional control, even though most partisan measures would likely face a presidential veto. Control of both chambers would give Democrats subpoena power, committee gavels, and greater ability to investigate the administration, shape the public narrative, and slow implementation of Republican priorities. President Trump's judicial and executive branch nominees would face a far more difficult confirmation process in a Democratic-controlled Senate.
All right, thanks, Scott. And now on to the third scenario. Republicans retain control of both the House and Senate. So if Republicans retain control of both the House and Senate, it would provide the clearest path for advancing the administration's legislative agenda. That could include additional affordability measures, a capital formation package, and potentially another round of tax legislation through the budget reconciliation process. That said, unified control doesn't necessarily guarantee swift action. The size of Republican majorities and the ability to reach consensus within the party will still be important, particularly on issues such as federal spending, deficits, taxes, and deregulation. So in this scenario, the winners and losers would be as follows. Financial services and digital asset firms could benefit from a greater likelihood of legislation that provides clearer rules for cryptocurrency markets, expands access to private investments, modernizes public company disclosure requirements, and reduces regulatory uncertainty. Federal agencies, including the SEC, would continue to play an important role, but Congress would have a greater opportunity to codify regulatory changes into law, making those changes more durable. At the same time, Democrats would have fewer opportunities to set committee agendas, launch investigations, or advance their own legislative priorities. Now, let's shift gears. The outcome of the midterm elections will shape domestic policy, but investors also need to keep an eye on broader global trends. Around the world, countries are placing greater emphasis on securing critical resources and supply chains. So now let's shift our focus to the global economy and the growing impact of resource nationalism. Resource nationalism is becoming an increasingly dominant global force, with governments asserting greater control over natural resources to strengthen both their economic and geopolitical positions. The result is likely to be structurally higher commodity prices as global competition for critical resources intensifies. Beyond the commodities themselves, commodity-linked equities, particularly in the energy and material sectors, as well as commodity-rich regions such as Latin America, could be well positioned to benefit from this trend over the long term.
That's right, Sue. And securing access to critical resources is only part of the equation. Those resources ultimately support the build-out of the AI infrastructure. Looking ahead to the second half of 2026, we believe AI will remain a dominant driver of the equity markets. At the same time, AI will be an increasing source of uncertainty as the investment cycle matures. In AI's next act, markets will face transition, moving from enthusiasm about the AI infrastructure build-out and surging earnings to a more balanced debate around the returns on the massive capital spending and who will be the biggest beneficiaries. Should AI's next act deliver, we believe U.S. and emerging market equities will continue to benefit given their leadership positions in the AI supply chain. However, the hyperscalers face risk that the investment cycle peaks, while AI tools may further disrupt certain software businesses. Capital investment by the hyperscalers has been extraordinary and continues to grow. These 5 companies, Alphabet, Amazon, Meta, Microsoft, and Oracle, may invest more than $750 billion in AI infrastructure in 2026, and that number may exceed $1 trillion in 2027.
Yeah, and the AI story isn't just about chips and data centers. It's also about the broader economic impact. When businesses invest at this scale, markets often begin to anticipate stronger economic growth. And one place we see that reflected is in treasury yields. The risk is that prolonged geopolitical stress kept energy prices elevated longer than expected and could amplify second-order effects across sectors. complicating the Fed's policy calculus. As a result, the Fed is likely to remain on hold in the near term, removing any bias towards easing and considering further tightening if conditions warrant, even as markets grapple with heightened uncertainty about the timing and credibility of any return to target inflation. The new Fed chair is creating a bit of uncertainty about the next rate decision, and the short end of the yield curve is rising. We expect the Fed to remain on hold, and in the meantime, the 2-year yield will be above the Fed funds upper limit.
Yeah, thank you, team. It's an interesting time, and of course, everything that we've talked about so far has a direct impact on the economy: disruption, division, AI, inflation, labor gap. Let's talk about a couple of those things. As we know, markets are continually adjusting to expectations for growth, inflation, and interest rates. To understand whether these expectations are justified, it's helpful to step back and look at the underlying economic fundamentals. Growth. We think that growth should moderate but remain positive in the second half, with strong business investment helping offset weakness in housing and other rate-sensitive sectors. In addition, spending on AI-related equipment, intellectual property, and non-residential structures will continue to provide an important cushion for overall activity. Elevated household net worth relative to income will continue to provide an important buffer for consumers and also help support consumer demand. Inflation should ease by year end. We expect inflation to moderate towards 2.9% by the end of 2026 if geopolitical tensions can ease meaningfully. And unemployment should edge higher but remain historically low, rising to about 4.6% by year end as hiring stays relatively subdued.
Yeah, thanks, Mike. So while we may see some cooling in the labor market, that doesn't necessarily mean the economy is losing momentum. In fact, one area we're watching closely is capital spending. The wealth effect continues to be a meaningful driver of economic activity, supporting healthy nominal growth over the next several quarters. Nominal growth remains an important contributor to corporate earnings growth. In addition, both well-heeled millennials and baby boomers are spending more than previous generations did at similar stages of life, providing continued support for consumer demand. If the 1990s serve as a guide, we believe the capital expenditure, or CapEx, cycle has further room to run. Ongoing business investment in software, IT infrastructure, artificial intelligence, and research and development should continue to support economic activity and GDP growth in the quarters ahead.
Yeah, that's right, Sue. And while the economy continues to show resilience and has the potential for further growth, that growth doesn't come without risks. One of the biggest challenges policymakers and investors continue to watch is inflation. We do expect inflation pressures to abate later this year and into next year. But in the meantime, consumer inflation will be a major concern for the markets and the Fed. For example, strong demand for healthcare services and geopolitical tensions have negatively impacted the inflation dynamic, and that will continue for the near term. However, our longer-term view is that the markets will perceive the Fed to be a credible and politically independent entity, which will help inflation expectations to remain well anchored.
And inflation doesn't exist in isolation. A healthy economy needs both stable prices and a strong labor market. So let's take a look at what current employment trends are telling us. The services side of the economy may continue to add to corporate payrolls for the next few quarters. We are still in a low fire labor market. Firms are still adding to their payrolls, but hours worked are below pre-pandemic levels as firms cut back labor utilization. A concerning trend is the increasing flow of individuals dropping out of the job market altogether. For now, the labor market is holding, giving the Fed the opportunity to stay focused on price stability. The unemployment rate ticked down to 4.2% in June, as fewer people were looking for a job last month. In a strong economy, a low unemployment rate can coexist with healthy participation rates, but that's not the case now. Hours worked declined in recent months, indicating an upcoming slowdown in broader economic activity in 2027. Labor force flows are revealing and provide another perspective on the labor market. We've seen a rising trend in people dropping out of the labor force, whether they were previously employed or unemployed. This suggests the job market is cooling down.
Yeah, and that strong job growth provides important support for the economy, but investors ultimately ask a different question. How does this translate into corporate profits, and how are my stocks going to do? Let's take a look. So expect the bull market to continue in the second half, bolstered by an improving macro backdrop, strong earnings growth, and AI execution. Developments in the Mideast and AI monetization progress will determine the magnitude and frequency of pullbacks. LPL Research expects modest gains for stocks in the second half and recommends a modest overweight allocation to U.S. equities to take advantage of this. And as always, diversification will be critical as portfolios may benefit from exposure balanced across the AI theme and potential beneficiaries of market rotation.
Yeah, and while diversification helps manage uncertainty, future market performance will largely depend on whether companies can deliver on earnings expectations. Let's see what the analysts have been forecasting. Stock market gains so far this year have been driven by earnings, not by higher valuations. First quarter earnings growth, sorry about that. First earnings quarters were driven by earnings, not higher valuations. First quarter earnings growth near 30% was extraordinary, and an encore is likely coming in the second quarter. AI-fueled technology earnings have far exceeded expectation, and as it illustrated in this rare and steady increase in earnings estimates chart, S&P 500 earnings per share estimates for 2026 and 2027 have risen by about 10% on average year to date, compared to an average 3% reduction. S&P 500 earnings per share are on track to grow over 20% this year, but growth is concentrated in the technology sector, which is expected to drive 2/3 of the overall increase. U.S. stocks are trading at slightly elevated valuations based on a simple price to earnings calculation, which has led some to characterize the stock market as overvalued. However, based on our macroeconomic outlook and corporate fundamentals, we would consider stock valuations fair rather than extreme. Stock valuations are a function of several factors that we believe are supportive of a slightly higher PE in 6 months, including 1, an above average earnings growth, 2, below average recession risk bolstered by stimulus and AI spend, 3, margin expansion opportunities from AI, and 4, potential for improving macro backdrop. Our confidence in the first 3 pieces of valuation support is fairly high, but the fourth piece, the macro backdrop, is a tougher to call. If the backdrop improves and the Iran conflict winds down, we expect to see some PE expansion as inflation pressures ease and interest rates potentially move lower.
Valuation matters across every sector, but nowhere has that conversation been more prominent than in technology. The sharp rally in semiconductor stocks on AI enthusiasm has sparked comparisons to the dot-com bubble of the late 1990s. From March 30th, 2025 through June 3rd of this year, 2026, the Philadelphia Semiconductor Index surged 225% compared with the S&P 500's 35% gain. Earnings may have justified the rally broadly, but the extreme move in some of the leading chip names was extreme and accompanied by stretch positioning. Simply put, market participants own a lot of AI names. That observation was the primary reason LPL Research Strategic and Tactical Asset Allocation Committee downgraded the technology sector in early June from a modest overweight to neutral, despite 50% earnings growth. The biggest winners of the AI trade may simply need a cool down period. The LPL Research base case assumes that more macro drivers break positively than negatively, allowing the AI-driven earnings boom to carry stocks higher in the second half. However, with uncertainty around geopolitics and the benefits of AI, and a lot of optimism priced in, volatility may remain elevated. Our updated year-end fair value forecast for the S&P 500 is 76.50 to 77.50, based on a 22 price to earnings ratio and 350 in the S&P 500 earnings per share in 2027.
Let's shift gears. Let's talk about bonds. And if you think about it, rather than viewing stocks and bonds as competing investments, we think of them as complementary tools. Current valuations in both asset classes help guide how we build balanced portfolios. A still resilient economy coupled with sticky inflation likely means the Fed is on a prolonged pause. As such, treasury yields are likely in a trading range until A, inflation falls meaningfully this year, and or B, the economy weakens. As neither represents our base case, we think the 10-year treasury yield will end the year within a 4% to 4.5% range. The additional compensation or spreads to own corporate credit remains muted. Though we could see upward pressures on spreads for the hyperscaler companies that are leaning into debt markets to fund the AI infrastructure build-out. Short to intermediate corporate bond exposure, including individual bonds, is attractive for income-oriented investors. Returns will likely be income-driven as treasury yields stay range-bound and credit spreads remain tight. Core and core plus models that overweight securitized markets and unconstrained strategies should perform well in our view. We prefer tips over nominal treasuries as well.
Thanks, Mike. And much of our bond outlook comes back to one key factor, the Federal Reserve. And over the course of this year, expectations for the Fed have shifted dramatically. Let's take a look at how markets have repriced the path of interest rates. At the beginning of the year, investors were focused on how many rate cuts the Fed might deliver. As the year progressed, however, markets began pricing in the possibility of a rate hike instead, with expectations for the Fed's neutral rate policy rate. This is the level that neither stimulates nor restricts the economy. The neutral rate moving closer to 4%. Even following the presumed US-Iran agreement as of this writing, markets continue to assign a higher probability to a rate hike than to a rate cut. Our view is somewhat different. Even under new Fed leadership, we believe the most likely outcome is one rate cut this year, potentially in December. And that remains contingent on the path of the geopolitical conflict and oil prices. At the same time, we believe the bar for a rate hike is even higher than current market expectations suggest. Some of the Fed's recent hawkish rhetoric appears intended to tighten financial conditions through market expectations, rather than signaling an imminent increase in interest rates.
Yeah, and with the Federal Reserve's hawkish stance has made capital more expensive, but it has also highlighted which companies have the financial strength to continue investing. The hyperscalers have been among those leaders. The AI story, long an equity market phenomenon, has migrated to fixed income. The hyperscalers, Amazon, Alphabet, Meta, Microsoft, and Oracle, once funded their ambitions almost entirely from internal cash flow, but no longer. Building data centers, securing chips, and powering them requires sums beyond even their formidable cash flows. These companies issued roughly $110 billion of bonds in 2025, more than 5 times their 2023 and 2024 issuance trends. And estimates point to some $300 billion of AI-related investment-grade supply in 2026, within record total issuance approaching $2 trillion or more. The borrowers themselves remain in excellent financial shape. Hyperscaler leverage runs at a fraction of the typical investment-grade company, and new deals are routinely oversubscribed. Still, the sheer scale is challenging the market's characteristics. Because data centers last decades, the bonds funding them are long dated, adding interest rate sensitivity to the corporate bond indexes. Technology's share of the corporate bond market has climbed to around 10%.
That's great, Scott. Let's talk about some other asset classes that are kind of in the background, because stocks and bonds remain the foundation of most portfolios, but today's market can also present opportunities beyond those traditional asset classes. As we've talked, the first half of 2026 has been marked by rate uncertainty, geopolitical risks, and policy ambiguity. This environment highlights the potential limitations of a traditional 60-40 portfolio and strengthens the case for alternatives as a source of diversification and flexibility. Some of these alternative investments are liquid alternatives. Some of them are market neutral, long short equity strategies. Global macro managers can benefit from diverging central bank policies, shifting rate expectations, and geopolitical uncertainty. Managed futures can also provide a valuable diversifier as well. There's also private assets. Private assets have shifted from being a beta-driven environment to one requiring greater manager skill in operational execution. As we talked about, infrastructure remains very attractive due to the inflation-linked cash flows and the growth opportunities. There's also private credit offers that offer compelling income potential, and then private equity also. In private equity, we think manager selection is increasingly critical, and with opportunities really concentrated in secondaries, carve-outs, and AI-related investments. The key message with alternatives is that markets are increasingly driven by dispersion, structural change, and complexity. Alternatives are starting to become core portfolio allocations that can enhance diversification, resilience, and return potential across market cycles. As we think about diversification beyond traditional stocks and bonds, it's also helpful to consider the role of currencies and commodities.
Among all commodities, oil continues to have one of the broadest impacts on the global economy. It influences transportation costs, inflation, corporate profitability, and even geopolitical relationships, making it a logical place for us to focus. The first half of 2026 had a historic commodity shock. The Iran war and Strait of Hormuz closure removed at least 10% of the global oil supply, which caused crude prices to surge above 120 a barrel within days. Energy shock pressured risk assets, growth expectations, inflation forecasts, and rate cut assumptions. This shock reinforced the commodity bull market. The Bloomberg Commodity Index briefly reached its highest level since 2013, and even after tensions eased, commodities entered the second half of the year with outperforming broader U.S. equities.
Yeah, and oil prices have normalized, but volatility remains. Crude oil prices have largely returned to pre-conflict levels, easing some of the concerns we saw earlier this year. However, uncertainty remains around several key factors: the timing of a full reopening of the Strait of Hormuz, the cost and pace of restoring normal shipping and production, whether the current ceasefire and peace agreement will hold. In the meantime, additional supply has entered the market as previously restricted barrels have been released and global demand, particularly from China, has softened. Now onto durable supply recovery is likely gradual, but not immediate. Even with the Strait of Hormuz reopening, global oil supply won't return to normal overnight. Tankers must be repositioned, production restarted, and infrastructure brought back online, all which takes time. While Gulf exports have increased and previously delayed shipments are moving again, the recovery is expected to occur in stages rather than all at once. Now let's talk about inventories that are remaining structurally tight. Despite improving supply conditions, global inventories remain relatively low. OECD oil inventories are projected to fall to the lowest level since 2003. Reopening trade routes helps restore supply, but it doesn't immediately rebuild inventories. With stockpiles still tight, the oil market remains vulnerable to any new geopolitical disruptions or unexpected supply shocks.
Yeah, and the technical setup shows oversold conditions. Brent crude has fallen below its 200-day moving average. Prices reset, retesting support in the low 70s near January and February highs, and bearish sentiment and speculative net long positioning are at contrarian extremes. So what's the bottom line here? Oil has retraced the war premium, but the market remains fragile. Tight inventories, unresolved logistics, and oversold positioning sentiment suggest continued oil volatility into the second half of 2026.
And just as oil prices shape inflation and economic growth, currencies influence global trade, corporate earnings, and international investment returns. The US dollar index enters the second half of the year nearly unchanged from where it started, but underlying macroeconomic forces remain highly dynamic. Global political tensions with Iran strengthened the dollar as investors sought safety, driving increased risk aversion. Higher oil prices, rising inflation expectations, reduced expectations for Federal Reserve rate cuts. As tensions eased, some of those supportive factors faded, but higher yields and improving rate differentials along with renewed confidence in U.S. exceptionalism, have remained a very steady tailwind for the greenback. From a technical perspective, the dollar remains at an important inflection point. A sustained move above 100.64 would confirm a bullish breakout from its current range and point to a minimum technical base price target near 105 to 106. A break below 95.5 would signal a breakdown and a more bearish outlook, as it would also violate the dollar's secular uptrend. So we covered a lot of ground there and in a pretty short period of time. We know that you probably have some questions, and as we wrap up today's mid-year market update, we want to encourage, well, first of all, we want to just sincerely thank you all for attending today, and we're grateful that you chose to spend a part of your day with us. We hope today's discussion has provided helpful perspective on the markets and reinforced the importance of staying focused on your long-term financial goals, even when the market is experiencing periods of uncertainty, as we've seen. If you have any questions about today's presentation or would like to discuss how these topics relate to your own financial plan, please feel free to let us know, and we will be in touch with you to answer any of the questions you've got. And one final thought, if the greatest compliment we can receive is the confidence you place in us by introducing us to people you care about. If you have a friend, family member, coworker, or anyone who you feel could benefit from a conversation about retirement planning, investments, tax strategies, or simply getting a second opinion on their financial picture, we'd be honored to have that conversation here at M2 Financial Group. As you know, there's never any obligation. We'll always be happy to be a resource and help people make informed financial decisions. Thank you again on behalf of the entire team, the team on screen, as well as the team in the background, still working hard to keep the promises that we make to you every day. It's truly a privilege for us at M2 Financial Group to serve you, and we look forward to speaking with you again soon. Have a wonderful afternoon, stay cool, and thanks for joining us.